Hello, and welcome to Explain the Charts, your go-to channel for in-depth technical analysis. Today is November 14th, 2025, and we are diving deep into Ethereum, or ETHUSD. It's been an incredibly volatile couple of weeks, and there's a lot to unpack on both the news front and the charts. First, let's talk about the major event that has been driving the market narrative recently. On November 3rd, news broke about a massive, multi-million-dollar hack on the Balancer protocol, which is a major decentralized finance platform built on Ethereum. This wasn't a minor event. Reports indicated over $100 million may have been lost. As you would expect, this sent a wave of fear, uncertainty, and doubt through the market. The immediate aftermath saw over $1 billion in liquidations across the crypto space, with Ethereum taking a significant hit. This kind of exploit naturally makes investors nervous about the security of the DeFi ecosystem. However, it's also worth noting that many long-term investors pointed out that despite these setbacks, Ethereum's underlying technology and its dominance in the DeFi space remain fundamentally strong. Now, let's see exactly how this bearish news event translated to the price action. We're starting here on the daily chart for ETHUSD, looking at the bigger picture over the last year and a half. Let's zoom in on the action from the beginning of this month to get a clearer view of the recent volatility. Here on November 3rd, you can see this massive red candle, a drop of nearly 8% in a single day. This is the direct market reaction to the Balancer hack we just discussed. The selling pressure didn't stop there. The next day, November 4th, the price plunged even further, hitting a low of around $3,061. This level, right around $3,050, immediately becomes a critical support zone for us to watch. What happened next was quite impressive from a bullish perspective. The price didn't stay down for long, staging a powerful V-shaped recovery over the following week. We saw an explosive rally of over 12% on November 6th alone, a clear sign of buyers stepping in at those lower prices. This rally continued all the way up to November 11th, where it peaked just shy of the $3,400 mark. This $3,400 area has now established itself as a major short-term resistance. However, since hitting that resistance, the momentum has shifted. Over the past 3 days, November 12th, 13th, and today, the 14th, we've seen a significant pullback. Sellers have taken control again, pushing the price back down. Most importantly, today's candle has wicked down to a low of $3,028. This means we are now directly retesting that critical support level established during the crash on November 4th. This is a pivotal moment for Ethereum's price in the short to medium term. To get a better sense of how this recent downtrend has unfolded, let's switch to a lower time frame. Here is the 15-minute chart, looking at the price action from the last few days. We can see the strong uptrend leading into November 11th and 12th, where the price began to struggle and consolidate around the $3,400 level. The momentum clearly started to wane, with buying pressure drying up. Then, on November 13th, the selling pressure intensified significantly. You can see the structure of the market breakdown, with a clear pattern of lower highs and lower lows forming. This is a classic sign of a short-term trend reversal. The drop was sharp and sustained, taking the price from the mid-$3,400s all the way down towards the $3,200 level by the end of the day. This aggressive selling on the lower timeframes is what led to the large red daily candles we just observed. It shows that sellers are currently in control and are actively pushing the price down to test key support. So, back on the daily chart, what does all this mean for traders right now? We are at a classic make-or-break point, caught between a strong recovery narrative and renewed bearish momentum. Let's outline the cases for both bulls and bears. The bearish case is straightforward and hinges entirely on the support level around $3,000 to $3,050. If we see the price close a daily candle decisively below $3,000, it would be a very negative sign. This would invalidate the entire V-shaped recovery and suggest that the bounce was merely a dead cat bounce. A break below this level would open the door to a much deeper correction. The next logical support targets would be the August lows around $2,600, and below that, the major swing low from September around $2,200. Now, for the bullish case. If buyers step in forcefully right here and defend this $3,000 to $3,050 zone, it could form a double bottom pattern. A double bottom at this crucial level would be a very powerful bullish reversal signal. It would indicate that the market has absorbed the bad news and is ready to resume its upward trajectory. The first sign of confirmation for the bulls would be a strong bounce that reclaims the $3,250 level. A more definitive confirmation would be a break and close back above the recent resistance at $3,400. If the bulls can achieve that, the next logical target would be a retest of the pre-crash levels around $3,900 to $4,000. There is also a third possibility, which is that neither side can take control, leading to a period of consolidation. In this scenario, we could see the price chop sideways between the support at $3,050 and the resistance at $3,400 for several days or even weeks. To recap, let's lay out the most important price levels to watch. Your critical, must-hold support is the zone between $3,000 and $3,050. Immediate resistance on any bounce will be found around $3,250. The major hurdle for bulls to overcome is the recent high around $3,400. And the next major upside target sits near $3,900. So, what's my unbiased prediction? Given the strength of the initial recovery, I believe there's a strong fight to be had here at support. I'll give a 45% chance that the price holds this $3,000 to $3,050 area and begins to bounce. This likelihood increases if we see a strong green daily candle with high volume form today or tomorrow. However, the recent selling pressure has been intense, so a breakdown is also very possible. I'd place the likelihood of a sustained break below $3,000 at about 40%. A daily close below that level would strongly reinforce this bearish outcome. That leaves a 15% chance for a prolonged period of sideways chop between the key levels we've identified. The main thing to watch is how the price reacts to this support zone over the next 24 to 48 hours. Thank you for tuning in to Explain the Charts. If you found this analysis helpful, please like the video and subscribe to the channel for more updates. Remember to do your own research before making any investment decisions. This video is for informational and educational purposes only and is not financial advice.